Are you the kind of intraday trader who struggles to find enough setups in your session? Or are you someone that finds yourself on the wrong side of the market too many times? If either of those or both of those are true, then stay tuned because this video is especially for you.
Swing structure is called swing structure for a reason. It's because it is best used by swing traders. Now, intraday traders need a different form of structure to extract profits from the market on a daily basis. Why? Well, the reason for this is that swing structure gives an overall view of the trend of price, whether we're making higher highs and higher lows or lower lows and lower highs, aka are we bullish or are we bearish? Swing structure shows us this over a long period of time so we can hold trades knowing that we are most likely capturing things with the trend going in the right direction. If we're intraday trading, we're most likely looking for those smaller moves, smaller RR, and shorter lasting trades that play out within our session, sometimes within minutes. What this means is that for intraday traders, they need to figure out the current flow of price rather than the overall swing trend so they can get in on those smaller moves, but still ensuring that most of the time they are on the correct side of the market. Now, the idea of swing structure is something I have absolutely no problem with. It gives you a really good framing of how structure and price is actually trending at any moment in time. So the idea would be it creates a low, a high, higher low, higher high, higher low, higher high. This is a bullish market. Then it might break the low and then start creating lower lows and lower highs, turning into a bearish market and then at some point breaking up again like this. So with swing structure, we would have technically our swing points after each break of structure like this. And this is a very simplified look at swing structure right here. Something like that. So after every break of structure, the lowest point before that would be the swing low. And then a break of a low. The highest point before that is the swing high, swing high, swing high, etc. Now, what a realistic swing structure actually looks like is something like this. So we have our swing points here, 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 and here. However, between that, we have all this price action going on. So you can see there are lots of movements, but they don't count as swing structure because we are currently within 2 swing points already. So it's only after a break of structure that we start mapping swing points like this. Okay, so all of this stuff kind of goes to waste. You can look at it in some ways as sort of minor structure or internal structure or substructure, something like that, but it all gets a little bit complicated. So why is this a problem for intraday traders? As an intraday trader who trades a strict 3-hour session, what I'm looking for are trades that play out within my session over a short period of time, targeting low RR. Now, the problem with using swing structure is that it's fairly unlikely that price is going to tap into that high probability area, for example, the discount of a bullish swing range within that 3-hour session every single day. So the frequency of trading as an intraday trader targeting low RR using swing structure is going to be very low. So my monthly return is also going to be very low because I'm not going to be taking many trades. As a swing trader, you don't need to take so many trades because you're most likely targeting much higher RR. So that is why swing structure is great for swing traders, hence the name. But what we need is a form of intraday structure. So looking at the same bit of price action, I've marked out how I would view it as an intraday trader up here. And this is going to be looking a little bit messy, but what I've marked out are the ranges of each leg. So we have all the bullish legs marked in red and the bearish legs marked in blue. And you can see I've literally mapped every leg like this. So from cemented low to cemented high, from cemented high to cemented low, from cemented low to cemented high, etc., etc. And this looks a bit messy here, But when you're at the very start of a session, and it could be at any point in this, you're instantly aware of the two opposing ranges that exist, and you're looking, you know exactly where you want to long from, and you know where you want to short from, and it is most likely going to hit one of those areas at least within your trading session. Okay, so let's look now at real life price and see how we can show this. So here we are on the 15-minute for Euro US dollar. The 15-minute for me is the very best time frame for intraday trading. The reason for that is that it's neither too fast that you get kind of lost in a bunch of noise and take too many setups, but it's also fast enough that I do get setups every day in my 3-hour session. So I called it kind of a Goldilocks zone of time frames in that respect. And so that is why I use it, and I recommend that it is used if trading this way. So what would I be looking at for my ranges? Now, if I was looking at swing structure, I'd first of all have to be certain that I was actually looking at the correct swing structure, and you have to kind of zoom out and make sure you're not just too zoomed in. So for example, if you were looking at this as a break of swing structure over here, you could be right, but you could be also absolutely wrong, because you might zoom out and see that actually we were in a much larger range of price where that we hadn't even broken out of yet. So you have to kind of make sure, and what I would do if I was using swing structure would be looking for these areas where there's a clear kind of taking out of lows and highs. This sticks out to me in that we've clearly taken out a bunch of lows and also taken out this high here. So I would be fairly confident in determining that this actually just created a new swing low and a swing high here with this big move. And then I would just go on from there to see where we continue to break and close above that to create the next swing structure. So did we break and close here? No, we just wicked above. I would say that the next swing point was actually over here, where we actually close above it. And what would be the swing low? It would be this lowest point before that close above. So that would be the new swing low. And then what happens next is we break the high. So the lowest point before the break of the high is there, and we actually break the high over at this point here. So again, as I was saying, you know, you could be too zoomed in on price with swing structure here, and where it might look like we've turned bearish at some point, or we think we're actually having a breakout of swing structure, we were just still trading within this larger range, which, you know, is absolutely fine to trade swing structure. But, you know, you're going to be waiting a long time, you know, a few days for price to break out this range. So for me, if I'm looking at this from an intraday perspective, I'm not going to be looking at swing structure. I'm going to be looking at what's currently going on. Now, I don't actually trade this time, but let's just look at current price anyway. It doesn't really matter. This is New York, around 3 p.m. UK time. My session is shown in this blue session indicator here. This is 7 a.m. to 10 a.m. right there. But what I'd be looking at in current price would be from this low to this high here as a range. That's the bullish range, and then there's a potential bearish range here. I say it's a potential range because we haven't yet closed a 50-minute candle above, we haven't cemented this low. So if this candle here closes above this candle here, that would confirm this bearish range. But before that happens, I won't look at shorts from this premium right here. I have to wait until we get that cemented low. So yeah, I'd have been looking at longs from this discount, which we obviously tapped into. Whether we gave an entry, I don't know, on the 1 minute, which is what I use for my entries. But yeah, that's how I'd look at it currently. Now, if we just go to today's London session, I'll show you what I would have been looking at for that. So this would be where price was at the very start of my session. And again, just looking at this immediate kind of bullish range here, and then the bearish equivalent, we had a range coming down here, it popped up, mitigated, and continued down. So this has been cleared, and now the current one would be, or the current potential one would be like this. I again would need price to cement a low before getting involved in any shorts here. So it's looking like it's coming down to give potential longs from this area. So yeah, it's potentially given a nice long there, which may have hit a target, but it still hasn't cemented a low for shorts here. And again, still hasn't, so I wouldn't have been looking at getting in short from this leg, and it's now taken out this bearish range. So again, that is invalid for the moment. So now it's kind of, after taking this out, it's cemented again a new high. So this is a new bearish potential leg. We're still within this bullish leg, so again, could still look at taking longs from here. And again, it continues down like that. Still hasn't cemented the low, and now it has. Now I could be looking at shorts from here if there was a valid setup. No, it has continued long from there and taken out this bearish leg, and now we have a new bullish leg of price. It's continuing, and it's just continued to shoot up, as you can see, and this is how I would be following price throughout the session. So really what I've gone into in this video is how I'm kind of following price throughout the day on the 15-minute. What I haven't gone into is the 1-minute entry, and that is something that I'm not going to go into in this video. But basically what I'm looking for is for specific unmitigated ranges on the 1 minute that are within these 15-minute either bullish discounts or bearish premiums. If you've been following MagicFX for a while, then you know how I would view like an unmitigated 1 minute leg, one that's open for business. It's something I've talked about a million times. So it's when price enters one of those areas, hits a valid zone, gives a break, that's when I'm getting involved. So if you want more clarification on this, I currently am offering one-to-one coaching calls. If you go to magicfx.net, you can jump on one of those and be, one of the first to find out how exactly I'm trading. I'll give you all the time that you need to understand exactly how I trade, and ask questions, and you'll get a PDF and a recording, and can ask questions afterwards as much as you like. If you don't fancy doing that, make sure you subscribe to this channel, because there'll be more and more content coming out, and head to magicfx.net anyway and subscribe to the newsletter, and you will be the first to know when the MagicFX Academy is back open and running, and that will be in the next month or so. Just got to iron out a few things first, but yeah, this is a very profitable way of intraday trading, and you'll have trades daily, and so yeah, there are a lot of nuances in it that I can't kind of go into everything in this video. There are nuances in the management and in which pairs I trade and the entry style and all that kind of thing. However, I hope this has helped you in some ways, or you can experiment with this way of looking at price, and it will enable you to kind of flow with the 15-minute structure on an intraday level and allow you to kind of get involved in trades. What I will say is that this is meant for low RR trading. It's not meant for long-term kind of swing trading where you're going to be holding it for ages, because it's just these small 15-minute ranges. And so, you know, it's not relying on being in a particular point in the charts where you're expecting price to go and absolutely melt or fly. It's just expecting that reaction on a short-term basis where you can just get that quick 1, 2, 3 R and get out of the trade. So yeah, don't go into this expecting to get, like, you know, a 30 R trade that just goes and goes and goes and goes. That can happen, but it's not like, we're not aiming for that. There's no real reason to aim for that with this, because I would never be confident enough in saying that this is going to go, or I'm going to aim for this one to go on and on and on. This is for short-term trading for those who prefer that psychological approach. So again, thanks for watching. Subscribe, like, share, and again, hope you enjoy the content, hope it helps.